Overconfidence is dangerous not because it looks reckless, but because it feels reasonable. It feels like clarity. It feels like understanding. It feels like competence. And that is precisely why it becomes one of the most expensive psychological biases in investing. Most people assume investors lose money because they lack information. They believe bad decisions come from ignorance, poor education, or not knowing enough about markets. In reality, many of the largest losses come from the opposite problem. They come from believing you understand more than you actually do. Overconfidence is the tendency to overestimate your skill, your knowledge, and your ability to control outcomes in environments that are fundamentally uncertain. Financial markets are uncertain by nature. That makes overconfidence uniquely destructive. The human brain craves certainty. It looks for patterns, explanations, and narratives that reduce ambiguity. Markets do not naturally provide certainty, so investors and traders manufacture it. This company is different. This setup is obvious. This trend is clear. This time, I know what will happen. At that moment, confidence quietly turns into overconfidence. Healthy confidence means trusting a process while respecting uncertainty. Overconfidence means trusting your judgment regardless of risk. The difference is subtle, but the consequences are massive. Consider a trader who experiences a series of winning trades. Objectively, this means very little. The sample size is small. Market conditions may simply be favorable. Luck may be involved. Psychologically, however, it feels like mastery. The trader feels sharper, more precise, more in control. They begin to increase position sizes. Risk limits start to feel restrictive. Rules that once felt necessary begin to feel optional. Overconfidence rarely appears as obvious recklessness. It appears as justified confidence built on recent success. When losses eventually arrive, the bias does not disappear. It evolves. Now, the trader believes the loss is temporary. They believe the market is wrong. They believe their original analysis will be proven correct. They hold. They add. They refuse to reassess. What began as confidence turns into stubbornness. Months of disciplined gains can disappear in a matter of days, not because the strategy was flawed, but because risk was underestimated when confidence was high. The same dynamic appears in long-term investing. An investor selects a stock, fund, or asset that performs well. Returns are strong. The decision feels validated. The investor attributes success primarily to skill. They believe their analysis was superior. They believe they identified something others missed. Gradually, portfolios become more concentrated. Diversification begins to feel unnecessary. Downside scenarios feel unlikely. Contradictory information is ignored. Critical perspectives are dismissed. Warning signs are rationalized away. When conditions change, the portfolio suffers disproportionately. Not because the original idea was irrational, but because the risk profile was never properly acknowledged. Overconfidence does not require arrogance. It requires miscalibration. The investor does not need to believe they are brilliant. They only need to believe they are right more often than they actually are. This is why overconfidence is so dangerous. It does not feel emotional. It feels rational. The solution is not insecurity. The solution is humility applied through structure. Markets reward humility because humility preserves capital. It keeps position sizes reasonable. It enforces diversification. It allows survival through uncertainty. Humility in investing is not self-doubt. It is the recognition that uncertainty cannot be eliminated. This recognition changes behavior. Position sizing becomes conservative. Risk per trade becomes limited. Exposure becomes intentional rather than impulsive. These choices often feel slow. They feel boring. They feel inefficient, but they are protective. One of the clearest expressions of overconfidence is excessive activity. The belief that more decisions lead to better outcomes is rarely true in markets. More decisions usually mean more opportunities for error. Overconfident investors trade more frequently. They believe they can time entries and exits with precision. They believe activity equals skill. In reality, activity often increases friction, transaction costs, emotional fatigue, and the likelihood of mistakes. Another signal of overconfidence is narrative rigidity. When an investor becomes emotionally attached to an explanation, updating beliefs becomes difficult. Evidence is filtered. Information is interpreted selectively. The question is no longer what is happening. It becomes, how can I justify my existing position? This is no longer analysis, it is defense. Markets punish rigidity because conditions change. Assumptions fail. Regimes shift. The investor who cannot adapt becomes fragile. The antidote to overconfidence is not pessimism. It is calibration. Calibration means aligning confidence with uncertainty. It means understanding that correctness in markets is probabilistic, not absolute. A calibrated investor asks different questions. How wrong could I be? What would invalidate this idea? What is the cost of being wrong? How much damage would that do? These questions do not eliminate uncertainty. They manage it. Risk management is the practical expression of calibration. It translates humility into behavior. Position sizing, diversification, and predefined loss limits are not constraints. They are survival mechanisms. To really understand how destructive overconfidence can be, you have to stop thinking of it as a personality flaw and start seeing it as a structural risk. Overconfidence does not appear suddenly. It builds gradually, reinforced by small wins, familiar environments, and narratives that make uncertainty feel manageable. The danger is that markets reward confidence just often enough to make overconfidence sustainable for long periods of time, and that delay between behavior and consequence is what makes this bias so expensive. Many investors mistake survival for skill. They mistake favorable conditions for mastery. They mistake being right temporarily for being right in general. This is why overconfidence often peaks near market tops, not because people become irrational overnight, but because success slowly removes caution. Risk controls are relaxed, position sizes grow, diversification is reduced. Downside scenarios are dismissed as unlikely. At that point, even intelligent investors become fragile. What eventually causes damage is not a single bad decision. It is the accumulation of small decisions made under the illusion of control. Markets do not require you to be wrong often to punish you. They only require you to be wrong once while being overexposed. This is why humility is not optional in investing. It is structural, it is functional, it is protective. Humility does not mean lowering expectations. It means respecting uncertainty. It means designing decisions that still work when you are wrong. It means accepting that the market does not owe you validation. And it means understanding that consistency matters more than brilliance. In the long run, the investors who survive are not the most confident. They are the most calibrated. They understand that uncertainty never disappears. They understand that risk cannot be eliminated. And they understand that the goal is not to predict the future, but to remain solvent long enough for probabilities to work in their favor. If you remember only 3 things from this video, first, confidence should decrease as uncertainty increases. The more uncertain the environment, the less certain you should feel. Second, small samples lie. Short-term success does not prove skill. It often proves favorable conditions. Third, position sizing is the real expression of humility. If risk is too large, confidence is misplaced. Markets do not punish ignorance. They punish overconfidence because overconfidence removes the safety mechanisms that protect capital over time.